China's crumbling economic story. There's a saying that when the United States sneezes, the rest of the world catches a cold. But what happens when China faces challenges? The world's second largest economy, with over 1.4 billion people, is grappling with a lot of issues. While these problems present a significant concern for Beijing, they might end up affecting the entire world. What do you think will happen to all those countries China supports? Will they bring the global economy down with them? Stick around to find out. Before we begin, be sure to like and subscribe to this channel for more exciting content. Many major global corporations, such as Apple, Volkswagen, and Burberry, heavily rely on China's vast consumer market for a significant portion of their revenue. As Chinese households tighten their spending, the repercussions will be felt throughout the global supply chain, affecting thousands of suppliers and workers worldwide. China has been a driving force behind a substantial portion of the world's economic growth, with over a third of it attributed to the nation. Therefore, any signs of an economic slowdown in China will have ripple effects extending beyond its borders. At the beginning of 2023, optimism was abundant, with hopes for a swift recovery in Chinese consumer spending and accelerated GDP growth. However, the world's second largest economy has since faced challenges. The current struggles in China's economy do not necessarily imply that the growth model of the past few decades has exhausted its potential. Nor does it mean that the Chinese century is at an end, as some have suggested, or that a looming crisis is inevitable, as President Joe Biden once characterized it. Nonetheless, China's economic challenges are not confined to its own borders, they have global implications. The trajectory of China's economy is a matter of concern for international leaders and investors who depend on it to drive global expansion and provide stability. A prolonged slowdown or a sudden financial crisis in China would send shockwaves through the global markets, affecting countries worldwide, including those in the Middle East, which have grown increasingly interconnected with China's economy. China, with its $18 trillion economy, has faced significant challenges. Economic growth slowed notably in the spring, disappointing hopes for a strong rebound after the stringent COVID-19 restrictions were lifted. Domestic manufacturing activity has been on the decline for the fifth consecutive month as of August. The services sector, a vital source of employment, has also seen weakening growth. Chinese consumers are tightening their purse strings, leading to decreased spending and putting pressure on the prices of goods and services, causing considerable concern about the overall state of the economy. The distress in China's housing market, a complex mix of finance, construction, and household wealth, is worsening. Country Garden, the nation's largest real estate developer, failed to meet bond payments and reported an estimated loss of up to $7.6 billion in the first half of the year. This escalating property crisis has raised worries about potential contagion risks. Country Garden carries a staggering $200 billion in unpaid bills. Troubled developer China Evergrande Group has recently filed for U.S. bankruptcy protection. In addition to these economic challenges, President Xi Jinping's government must also address the substantial issues within the country's shadow banking sector and grapple with the substantial debts owed by local governments. The global trade landscape has also been a source of concern, further intensifying China's economic difficulty. Central banks in Western countries have raised interest rates in an attempt to control inflation. This, along with weakening consumer demand in advanced markets, has led to a significant decline in Chinese exports. This year alone, Chinese currency reached a 16-year low against the US dollar. Meanwhile, China's recovery, driven by consumer spending, has been shallow and short-lived. China was once considered to be the next United States. It had all the necessary ingredients, but unfortunately, reality has caught up to them. Now, A struggling labor market and slower growth in disposable income have shaken public confidence in the country's economic situation. This has resulted in high precautionary savings rates, sluggish retail sales, and a notable decrease in imports. New foreign investments in China hit a 25-year low in the second quarter of 2023, as investors reduced their exposure due to economic uncertainty and escalating geopolitical tensions with the United States. Beijing's measures to reduce risks, crackdowns on major technology companies, and sudden regulatory changes have deterred foreign investors. Rising costs and concerns about the supply chain have also played a role. Notably, foreign investment has continued to decline throughout the summer. Adding to the concerns about China's future economic growth is the decrease in transparency in Beijing's reporting of fundamental economic data. In early August, Beijing announced its decision to stop disclosing figures related to youth unemployment, just weeks after it had reached a record high of 21.3% in June, reflecting a trend of concealing unfavorable economic data. Soon after hearing this, the National Bureau of Statistics halted the publication of the Consumer Confidence Index. Additionally, a major Chinese data provider has restricted access for international users. Zhang Jinhua, the director of the National Energy Administration, recently called on officials to foster a culture of confidentiality, emphasizing secrecy and caution. These actions, including the suppression and falsification of economic data, have eroded global confidence and intensified concerns in the financial markets. Last February, the International Monetary Fund stated that sustaining the economic recovery in China would require a combination of monetary and fiscal support, along with accelerated structural reforms. In the midst of this, Chinese authorities have initiated measures to bolster their economy. However, their efforts have primarily taken the form of pledges and policy guidelines directed at specific sectors or designed to reassure investors, often lacking specific details. For instance, the People's Bank of China reduced interest rates in June, a conventional tool to stimulate growth. Nevertheless, policymakers seem hesitant to implement a comprehensive stimulus package to boost consumption. Amidst a struggling economy recovery and growing calls for China's policymakers to take more decisive action, China's economy has fallen into deflation. In July, consumer prices decreased for the first time in 2 years. Chinese officials have tried to put a positive spin on the country's economic challenges, downplaying the risks of deflation. The official press has remained confident in Beijing's efforts to stabilize markets, emphasizing that despite a sluggish global economy, China has navigated economic challenges effectively. However, foreign businesses and investors hold a different perspective. Reflecting uncertainty about China's short-term economic direction, several Wall Street banks have lowered their GDP growth forecast for China in 2023. The outlook for China has significantly darkened. In addition, Fitch, a U.S. credit rating agency, noted that China's slowdown was casting a shadow over global economic prospects and revised its global forecast for 2024 downward. Nonetheless, some economists argue that the notion of China as the primary driver of global prosperity has been greatly overstated. In mathematical terms, China contributes to approximately 40% of global economic growth. However, the benefits of this growth are largely confined to China itself, as it maintains a significant trade surplus, exporting far more than its imports. Consequently, China's economic growth, or lack thereof, primarily affects China rather than the rest of the world. Despite this, when China reduces its spending on goods, services, or construction, it results in decreased demand for raw materials and commodities. In August, Chinese imports were nearly 9% lower compared to the previous year, when the country was still grappling with COVID-19 restrictions. This reduction in Chinese demand has a significant impact on major exporting countries such as Australia, Brazil, and several African nations. So, why does the decline in prices in China raise concerns? Weak demand in China leads to low prices in the country. From the perspective of Western consumers, this can be seen as a welcome way to counter rising prices without raising interest rates further. This is positive news for individuals and businesses struggling to cope with high inflation. In the short term, ordinary consumers may benefit from China's economic slowdown. However, there are long-term implications, particularly for people in the developing world. Over the past decade, China has invested over $1 trillion in massive infrastructure projects under the Belt and Road Initiative. More than 150 countries have received Chinese funding and technology for constructing roads, airports, seaports, and bridges. If China's economic problems persist, its commitment to these projects may waver. Considering China's global position, a more vulnerable China might aim to mend strained relations with the United States. American trade restrictions have contributed to a 25% drop in Chinese exports to the U.S. in the first half of this year. U.S. Commerce Secretary Gina Raimondo recently referred to the country as uninvestable for some American firms. Yet, there is no concrete evidence to suggest that China's approach is softening. Beijing continued to respond with its own restrictions, frequently condemning the Cold War mentality of Western nations and maintaining strong ties with authoritarian leaders of sanctioned regimes, including Russia's Vladimir Putin and Syria's Bashar al-Assad. At the same time, a steady stream of US and EU officials continue to visit China each month to engage in talks on bilateral trade. They certainly don't want to lose China's favor, even though the country appears to be falling apart. Do you think China would be able to bounce back and challenge the states? Let us know how you think this would play out in the comments. Be sure to like and subscribe for more exciting videos. Where money matters, we'll see you on the next one.